In the most recent interview with Paul Tudor Jones on CNBC, he has uttered the now very famous words on the internet: all roads lead to inflation. Welcome to Personal Finance Cat, where I share my personal take on personal finance. If you don't know who Paul Tudor Jones is, he is a prominent American hedge fund manager and founder of Tudor Investment Corporation, a successful asset management firm he launched in 1980. He gained wide recognition for predicting the 1987 stock market crash, where he profited by shorting the market just before its sharp decline. This achievement solidified his reputation as a skilled macroeconomic investor and market strategist. As of 2024, Jones' net worth is estimated to be approximately $8 billion. In this interview, Jones pointed out that no matter which U.S. presidential candidate ended up winning, they were going to have to take drastic fiscal measures, meaning raising taxes and/or lower spending. But even with those, it's not enough to pay for all the federal programs, including the interest on the existing debt. And therefore, the Fed will have to print more money, which leads to further inflation. Let's listen to a clip from this interview by CNBC.
You can raise the capital gains rate from 21 to 28%. That only gets you $10 billion a year. It actually doesn't get you what you need. So I'm simply showing some of the things that you can do. Yes, you'd have to raise the tax rate, raise the Social Security from 65 to 70, means test, Medicare. If you do all these things, all you do is you get to a primary balance. What that means is you stabilize debt to GDP. You're still actually increasing your debt.
Right.
You're still actually increasing it because it excludes the interest cost, which, oh, by the way, the interest bill this year is larger than every single line item except Social Security. It's larger than defense spending, larger than Medicare.
Given all of the things you're saying, are you off buying gold and Bitcoin and
I think all roads lead to inflation. I'm long gold. I'm long Bitcoin. I think commodities are so ridiculously underowned. So I'm long commodities. I think most young people find their inflation hedges via the NASDAQ. That's also been great.
As Paul Tudor Jones points out, these conditions create a landscape in which inflation is not just likely, but almost certain. This is especially true given the record levels of government debt, which make it challenging to reverse these policies without causing significant economic contraction. In simple terms, it's a one-way road where the primary response to economic stagnation is to inject even more cash into the system, diluting the currency's purchasing power. While we've seen low inflation over the past decade, the post-pandemic world is very different. Supply chain issues, labor market tightness, and global geopolitical challenges are adding pressures that can easily exacerbate inflationary trends. I'm not a macro gal, but even I can see very clearly that there is no easy way out. Jones thinks that we are going to have to, quote, inflate our way out, end quote. Specifically, the Federal Reserve should be running nominal interest rates lower than inflation and supporting nominal economic growth above inflation. What does he mean by that? First, if interest rates are kept lower than inflation, it means that borrowing money is cheap. When people and businesses borrow at these low rates, they're effectively paying back less in real value over time because inflation reduces the value of money. This approach can help reduce the real burden of debt over time and encourage spending and investment. Second, by focusing on keeping the economy growing faster than inflation, the Federal Reserve can help ensure that the value of goods and services produced in the economy increases. When growth outpaces inflation, it means people generally earn more and have more wealth, which helps balance out the rising costs of goods due to inflation. In short, even though he's proposing contractionary fiscal policy, again, it means raising taxes and lower spending because it's unavoidable. He thinks that the Fed should have expansionary monetary policies, i.e., lowering interest rates. And hopefully, with these two combined, inflation can gradually come down and people don't feel the pain as much. But one thing seems certain, inflation is not going away anytime soon. As an investor, how do you protect yourself? And better yet, set yourself up for success? Paul mentioned a few assets: gold, commodities, and of course, Bitcoin. The internet exploded with joyous Bitcoin people who cited the brilliant words Jones spoke.
I probably have some basket of gold, Bitcoin, commodities, and NASDAQ, something like that, and I would own zero fixed income.
Gold and commodities have existed for a long time, and the reason is pretty clear why, during an inflationary period, they are a good investment. The scarcity, the demand, and the fact that they can serve as a hedge against currency devaluation, which comes with inflation. But why is Bitcoin a good long-term investment? There are quite a few reasons, some of which are similar to why gold and commodities are good. Before I dive in, though, I wanted to say that my journey with Bitcoin has started in 2017/2018, and my view towards it has changed over time. I have more and more reasons to believe that it is a good long-term investment, thanks to the likes of Michael Saylor, whose detailed discussions on Bitcoin's technical aspects made it very convincing why it's superior to many other investments. In particular, I remember his discussion on the Friedman podcast, detailing why the SEC decided that Bitcoin should be classified as a property instead of a security. So in other words, Bitcoin is more like real estate or gold than a company's stock. Why does that matter so much? I'll give you a simple example. If you've lived in the US or probably anywhere else, you have seen how real estate prices have soared over the last few decades. Again, inflation makes everything more expensive, unless you have properties like real estate to keep up with or hopefully outpace the rate of inflation. As usual, I recommend that you listen to the full interview Michael Saylor did on the Friedman podcast, which I'll link in the show notes. With that backdrop, let's dive into the reasons why Bitcoin is a good long-term investment, especially in the face of an inflationary environment. Number one, Bitcoin's limited supply. Bitcoin has a hard cap of 21 million coins. This limited supply is encoded in its protocol, meaning it cannot be manipulated by any individual, corporation, or government. Unlike fiat currencies, which central banks can and do print in unlimited quantities, Bitcoin offers a fixed supply that acts as a natural hedge against currency devaluation. In an inflationary world, assets with finite supply become more valuable as the purchasing power of traditional currencies erodes. Number two, decentralization makes it resilient against governmental and institutional manipulation. Unlike traditional assets, Bitcoin isn't tied to any nation's economy, central bank, or political agenda. As a result, it appeals to investors as a neutral and uncorrupted store of value. This is especially appealing in times of geopolitical uncertainty, where fiat currencies are subject to the policies and stability, or lack thereof, of their issuing governments. Number three, an alternative to gold. Traditionally, gold has been the go-to hedge against inflation. While it remains a solid option, Bitcoin brings something new to the table: digital portability and ease of transfer. Bitcoin can be moved quickly and securely across borders without the logistical limitations associated with physical assets like gold. For a digital-first generation of investors, Bitcoin is fast becoming the preferred choice, offering the promise of digital security along with the inflation-resistant qualities gold has historically provided. Number four, growing institutional acceptance. Bitcoin's adoption by major financial institutions is another factor that strengthens its long-term investment case. Companies like Tesla, Square, and numerous hedge funds have added Bitcoin to their balance sheets. And with regulators around the world working toward more clarity around digital assets, Bitcoin is likely to continue integrating into mainstream financial systems, making it an increasingly accessible inflation hedge. I can go on, but perhaps the most convincing one-liner argument that I heard about why Bitcoin is here to stay is that, quote, if it's a scam, it would have died down by now. That being said, no investment is without risks, and Bitcoin is no exception. The cryptocurrency market remains volatile, and regulatory risks, particularly in countries like the US and China, could impact Bitcoin's value in the short term. Additionally, while Bitcoin's limited supply is appealing, its price can be influenced by speculative trading, leading to short-term price swings that are challenging for conservative investors to stomach. However, for those with a long-term perspective, These risks are outweighed by the potential of Bitcoin as a hedge against inflation. As more investors, institutions, and even governments recognize the limitations of fiat currency in an inflationary world, Bitcoin's appeal is likely to strengthen. To summarize, in a world where all roads lead to inflation, Bitcoin stands out as a compelling long-term investment. Its finite supply, decentralized nature, and growing adoption make it a unique store of value that isn't beholden to any one government or economic system. For investors looking to protect their wealth from inflation and currency devaluation, Bitcoin offers a new path forward. It's not without risks, but in today's inflationary climate, it might just be one of the best investments you can make for the future. All right, that's it for today. Do you agree with the message? You think we should just keep calm and dollar cost average into Bitcoin? Let me know in the comments section. Thank you so much for listening. Bye for now.